Jim Caron of Morgan Stanley saying he's not bearish, but skeptical, writing this: inflation is creeping higher and puts further scrutiny on the Fed's ability to cut interest rates. Tensions in the Middle East also create a potential for a more systemic type of risk. We can't forget that a bull in a candy shop is still just a bull, and bulls can be unpredictable. Jim joins us now for more. Jim, welcome to the programme. Let's run with that analogy. A bull run, if you will. A bull in a candy shop. Do you think we're a little too high on sugar right now?
I think that's a good way to put it. I do think of it as a little bit of a sugar high. My concern is that we're pulling forward 2025 earnings right now, and we're painting an almost near perfect picture going into the future. It's not that I'm bearish. It's not that I'm negative on the markets broadly. I just think that we're getting a lot happening really, really quickly. In other words, we're getting this soft landing that everybody's been projecting, but we're getting it very, very fast. Valuations reflect that, right? So if you look at $280 earnings, let's say for 2025, which is roughly consensus, you assign a 21 or a 22 multiple to that, you're going to get an S&P somewhere close to around 6,000, and that's about where we are today. But if you take that valuation down a little bit and you get it a little bit more normalized to say maybe a 20 PE on those $280 earnings, then the S&P is 5,600, right? So it's lower than where it is today. It's not a disaster, but net, we're talking about a few percentage points in either direction. I don't necessarily think that we're going to be in a very strong bull run from these levels or from these valuations. So that's where my skepticism is. I'm not saying that things aren't okay. Consumers strong, retail sales was good, inflation, earnings, GDI numbers are all good. So incomes are good, so people can keep spending. What I'm saying is, how much can it continue at this rate of change?
Well, let's take the valuation piece of it, Jim. This is what Cameron Dawson of New Edge said over the weekend. You could have argued at any point over the last year that stocks were expensive. I'm sure you'd agree with that. But there needs to be a catalyst to change this march to ever higher multiples. It feels like, Jim, we're in this virtuous cycle right now, looking for a disruptor to it. And Torsten Slock of Apollo spoke to the same thing. The Fed's cutting rates. They've got a bias to cut even more. So we've got a dovish Fed. We've got high stocks and high home prices. Public and private financing is wide open, as you can see. Continued support from fiscal plans. Low debt servicing costs that are locked in for both corporates and households as well, Jim. That's just feeding on itself. So the outlook just keeps on improving. Now, Jim, from your perspective, do you have anything in mind that could disrupt that process at the moment? Because that's the reasons people are so bullish right now.
Yeah, and I agree with those reasons, and it's why we maintain a bullish tilt in our portfolios as well. Moving more towards neutrals, not moving towards negative, because we do think that there are some potential factors. Clearly tensions in the Middle East, a flare up there. We could get some election uncertainty or some election volatility around this. But ultimately, what we would need to see is damage done to the consumer and a rise in the unemployment rate. So I think some of the damage that could come is that if we start to see some weakening of the labor market. Now, we're not seeing signs of that yet, but we all know that the non-farm payroll data has been heavily revised over time. And if we do start to see that in a period where we start to see some margins starting to shrink across corporate America, that could create a significant or a faster move higher in the unemployment rate. And that would completely change the narrative. We're not there yet, Jonathan, and I think that's the most important thing to highlight. We're not there yet, but we do have to recognize that at these valuations and at these levels, that it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.